Imagine a business owner that comes to you in a conversation sometime this weekend and says, well, my business is doing really well, but I never know where the cash is. You know, the cash keeps slipping through our fingers. The bookkeeper keeps on telling us how much money we're making, but we never seem to have cash in the bank. This might be an insight into what could be happening in that business. Most business owners have a reasonable understanding of what's happening through their profit and loss statement. Imagine a situation where a business is turning over $500,000, and it has cost of goods sold of $200,000 and makes a gross profit of $300,000. Hopefully we haven't lost anyone yet. Business owner has expenses of $175,000 and makes a net profit of $125,000. Now that sounds like a pretty good business. However, this business owner is wondering that as they're growing, where is all the cash going to? Because it's not in their pocket. And it'll often be because they don't have a feel for and aren't managing their balance sheet. So a couple of the key drivers for cash flow out of the balance sheet are these. This business has $80,000 in receivables or trade debtors. It has stock and or work in progress of $100,000. Against that, it has payables or trade creditors of $20,000. Now, the first thing you want to do is understand what are the inflows and outflows from a cash flow point of view. Obviously, income is good. It should be cash coming into the business, or will eventually. Cost of goods sold, and I use my red pen here, is a cost to cash flow because there are expenses going out of the business. Expenses, again, going out of the business. Now, receivables are assets. That's money that is owed to us. But it is $80,000 that we haven't received from the $500,000 of income. So it is a cost to cash flow. Banks will even lend you money against receivables, but it is a cost to cash flow. Similarly, if you've had to put floor stock into your business, or you had to work on a job before you've been able to invoice, they are similarly costs to cash flow. The payables is holding off suppliers and paying them later on, so it improves your cash flow. So to finish off these balance sheet items, we've got $180,000 in receivables, $100,000 in stock, that's $180,000, and net of payables, it means we have $160,000 locked up in working capital. Now, many business owners out there think that their working capital is the amount that they've got in their bank account, but their bank account is in fact what they have left over after movements through the profit and loss statement and movements in the balance sheet. The bank account is what you've got left over. So to work out what's happening with the cash flow in this business, we're going to work out something we call CASHFLOWNAV Factor. going to do is we're going to work out a ratio of our cash flow benchmarked against the income of the business. So we're going to divide each of these key drivers of cash flow from our financial statements. We're going to divide it by the income and multiply by 100. We'll start here with income. So 500,000 worth of income in this line, divided by the 500,000 that we're going to divide each of these drivers by, is 1, multiplied by 100, is 100. So that's the ratio we're working to. 200,000 divided by 500 times 100 is 40. The minus comes across, and we're left with what's called a gross margin of 60 cents in the dollar. It's now going to start bringing the balance sheet into this calculation. So similarly, we'll have the cash flow NAV factor calculated on these key drivers out of the balance sheet. 80,000 divided by 500 times 100 is 16. The minus comes across. 100 divided by 500 times 100 is 20. And 20 divided by 500 times 100 is 4. So 16 and 20 is 36, less 4 is 32. We take this working capital factor and bring it over here and take it away from the gross margin. 32 from 60 gives us 28 cents in the dollar. And then we work out the factor of the expenses. 175 divided by 500 times 100 is 35. Now we can start to see what's happening in this business. 35 away from 28 is minus 7. This business has a cash flow factor of minus 7. What that means is, for the next dollar the business grows, the business owner's got to find 7 cents to fund the business. Because business owners are motivated to grow their businesses, and they might think that to overcome their cash flow issues they could sell more. If we took a simple example of wanting to grow this business by 10%, we would have an extra 50,000 in sales. So our sales would go up to 550. Our cost of goods sold will go to 220. We'd make 330. Our expenses might go to 192.50. That's an increase of 10%. And we're going to make $137,500. So that's an extra 12,500, or an extra 10%. Wonderful. However, if we're not managing our balance sheet, well then similarly our receivables will go up, our stock will go up, and our payables will go up, moving our working capital deeper to 176,000. So that's an extra 16,000 invested in working capital. And lo and behold, 16 away from 12.5 has left the business owner $3,500 short. Now what's really interesting is, with the information of our cash flow factor in hand, we can actually take the growth expectations of the business, multiply it by the cash flow factor, and sure enough, it would have told us in advance that we're going to be short by 3,500, which is the same number as we have here. So the first of our financial must-dos is to always know what your cash flow structure is by calculating your cash flow NAV factor. course there are many ways to improve that business. We'll cover those at a later time.